All right, welcome to Talk Tickers. Today, we're cracking open Exzeo's very first report card as a public company. An IPO, it's really just a promise. But that first earnings call, that's the first taste of proof. So let's dig in and see what the numbers, and more importantly, what the market had to say. Okay, so boom. Right out of the gate, the number that just jumps off the page is this. Plus 90%. I mean, wow. That is the year-over-year revenue growth. That is a massive, massive figure for any company, let alone one that just hit the public markets. So with a print like that, you'd think the stock would just soar, right? Well, not so fast. And if you just look at the headline numbers, it was a clean beat. No question about it. Exzeo sailed past Wall Street's consensus on both the top and the bottom lines. Earnings per share came in at 25 cents, a whole 4 cents ahead of what everyone was expecting. And revenue, they hit over 55 million, beating by more than 750,000. So, by all accounts, a really solid first report card. And yet, despite that clean beat, the stock actually dipped. It was down about 1.4% in after-hours trading right after the call. Now, that's not a huge drop, but it's the direction that makes you go, So what on earth did the market see that wasn't in those shiny headline numbers? Let's break down the story they were telling. So management's core story, the one they pitched hard during the IPO, is all about this idea of insurance as a service. And the key thing to get here is that they aren't an insurance carrier themselves. Nope. They're the tech platform, the high-margin engine that other carriers run on. It's a great model. When their clients grow, they grow, almost automatically. And this slide, this is that story in a picture. Just look at the adjusted EBITDA margin. It rocketed from 32% to nearly 55% in just 1 year. This is the proof point for what they call operating leverage. Think of it like this. It's like having a software factory that can suddenly produce twice as much stuff without needing any new machines or workers. They can handle huge amounts of new business, but their own costs barely budge, so profits just explode. So what's the engine driving that incredible margin expansion? It's all about this underlying growth. Their annual recurring revenue, ARR, that's now over $192 million. The managed premium, which is just the total value of all the insurance policies running through their platform, that hit a whopping $1.2 billion. And they're not done. They keep adding clients, now up to 6 carriers. These are the key ingredients feeding that super scalable model. Okay, so let's recap. The quarter was great. The business model looks absolutely fantastic. So where's the disconnect? Why did the stock dip? Well, it all comes down to the forward-looking guidance and a very, very important catch. Now, this is where things get really interesting. Look at this guidance table. The full year 2026 guidance for pre-tax income looks strong. Their targets for managed premium, solid. But then you see it. Look at the guide for Q4 pre-tax income, 22 to 25 million bucks. Wait a minute. That's actually a decrease from the roughly 28 million they just printed in Q3. And that is the number that gave the market some serious pause. So why the dip? The CFO basically laid it all out during the Q&A, and this is the absolute key to the whole puzzle. She said, and I'm quoting here, "The additional managed premium coming in the platform in Q4 will become revenue in 2026. Bingo! This is a classic timing issue. They are signing up a ton of new business right now, but because of how accounting and onboarding works, the actual revenue from all that great new business won't hit the income statement until next year." So this slide really sums up the whole dilemma for the market, right? The bull case is crystal clear. You've got fantastic growth, a high-margin model that's scaling beautifully, and a really solid guide for the full year 2026. But the nuance, the little bit of sand in the gears here, is this timing thing. The Q4 premium growth won't show up as revenue until Q1 of 26, and that's what's causing that weird-looking sequential dip in income. Okay, so with all that in mind, let's shift gears to our view. We'll piece this all together into a rating and talk about what we're going to be watching for on the next call. So we're kicking off our coverage with a market perform rating. What does that actually mean? Well, it means we expect the stock to pretty much move in line with the broader market for a little while. The long-term thesis is absolutely intact. This looks like a fantastic business. But, that post-IPO choppiness, combined with this revenue timing nuance, it just creates enough short-term uncertainty to keep us on the sidelines for now. Now, to get more positive on this thing, here's exactly what we need to see. It's a 3-point checklist. First, that Q4 managed premium number. They guided to a floor of $1.32 billion. Did they beat it? And by how much? Second, we need to see clear proof early in 2026 that those new carriers are actually converting to revenue like they promised. And third, they've got to keep proving they can convert all this into cold, hard cash. If they hit these points, the story probably gets a big upgrade. All right, last thing. Based on all this analysis, let's have a little fun and explore an outrageous but plausible scenario for how this whole thing might play out in the market. So here's what we're calling the Q1 2026 re-rate trade. It's a three-step dance. Step 1, the setup. The stock could just kind of drift. It might consolidate for the next few months while the market tries to wrap its head around this timing confusion. Step 2, the catalyst. The Q1 2026 earnings report. That's the magic moment when all that premium growth from Q4 is finally expected to land on the revenue line. It could set them up for a monster beat-and-raise quarter. And step 3, the trade. The idea here would be for patient investors to build a position during that consolidation phase, getting in before a potential re-rating event after that Q1 report.
And of course, we have to say it, this is for informational purposes only. This is not financial advice.
So we'll leave you with this question to chew on. Will the market be patient enough to look past the short-term lumpiness and reward Exzeo's incredible long-term scaling story before the numbers actually prove it out? Or is there a real opportunity here for investors to get ahead of the curve? That's the billion-dollar question, isn't it?